If you've been thinking about trading futures but aren't sure where to actually start, this video is for you. I'm going to walk you through the process step by step. What futures are, what you need before you open an account, how to pick the right contracts, and how to start building experience without taking on unnecessary risk. By the end of this, you'll have a clear picture of what the path forward looks like. Let's start from the beginning. So, what is futures trading? A futures contract is an agreement to buy or sell a specific asset at a predetermined price on a specific date in the future. These contracts trade on regulated exchanges like the CME Group. You're not actually buying the actual asset, you're trading a contract that's tied to its price. Futures cover a wide range of markets. Equity indexes like the S&P 500, commodities like crude oil and gold, currencies, interest rates, and even crypto. What makes futures different from stocks is leverage. You control a large notional value with a relatively small amount of capital. That's what makes futures both powerful and something that requires real preparation before you trade live. Before you open a futures brokerage account, there are 3 things worth getting clear on. First, understand the basic mechanics. Understand what margin is. Know the difference between a long and short position. Understand what a tick is, and know contract size affects your dollar risk per move. You don't need to be an expert, but these fundamentals matter from day one. Second, decide on a market. Don't try to trade everything at once. Most beginners do well starting with 1 or 2 very liquid contracts, something like the S&P 500 or NASDAQ. These are high volume markets with tight spreads and plenty of educational resources available. Third, figure out your starting capital. You need more than just the bare minimum margin requirement. Give yourself enough room to absorb normal price movement and trade without being forced out of positions by a margin call. Not all futures brokers are the same. There are a few things worth comparing before you commit. First, commissions. Futures commissions are charged per side, meaning you pay once to enter and once to exit. Lower commissions matter more as you trade more frequently. MetroTrade charges 29 cents per side for micro contracts and $1.09 per side for E-minis, which puts it among the lower cost options for retail traders. Next is intraday margin rates. Some brokers offer significantly reduced intraday margins compared to exchange-set overnight rates. For example, MetroTrade's intraday margin for the micro S&P 500 is around $50, compared to the overnight margin, which is thousands of dollars. Next is the platform. You'll spend a lot of time in your trading platform. Make sure it has the charting tools, order types, and layout flexibility that you need. Most brokers offer a demo you can test before funding your live account. Finally, it's regulation. Make sure your broker is registered with CFTC and is an NFA member. This is a non-negotiable for any US-based retail futures trader. Opening an account is straightforward. You'll fill out an application, go through an ID verification process, and fund your account once you're approved. The whole process typically takes a few business days. You don't need a complex strategy to start. You just need a repeatable process. Here's the simple framework that works for most beginners. Step 1. Pick one contract in one time frame. Start with MES or MNQ on a 5 to 15 minute chart. One market, one chart. Don't add complexity until you've built consistency. Step 2. Track your trades. Keep a simple log. Entry, exit, why you took the trade, and what happened. Reviewing your trades regularly is how you spot patterns in your own behavior. In step 3, give it time. Most traders don't find their footing in the first week or even the first month. The learning curve is real. The goal in the early stages is to stay in the game, manage risk, and build experience. Here are a few things that trip up beginners more than anything else. First, over-leveraging. Just because the margin requirement is low doesn't mean you should trade the maximum position size that your account allows. Start small. The goal is learning, not maximizing exposure on day one. Next is trading without a stop loss. Every trade needs a defined exit if it goes against you. Removing a stop loss mid-trade because you think the market will come back is one of the fastest ways to take a large, unplanned loss. Next is watching P&L instead of price action. When you're new, it's easy to fixate on your profit and loss number as a trade moves. That usually leads to exiting winners too early or holding losers too long. So that's the process. Understand the basics, get your capital in order, choose a broker, build a trading approach, and then track your results. Futures trading has a learning curve, but it's learnable. The traders who stick around are usually the ones that started with a plan and respected their risk limits from day one. If you want to get started with futures, open an account at MetroTrade.com.